Suzanne Duncan, I want to tell you, as I told her yesterday, she brings out the worst in people. That's why we made her the moderator. Last year, she was on a panel which involved Sheila Bair. Some of you were here. I think, Marcus, you were here. Sheila Bair and Ray Natter, and we literally had, Suzanne was moderating it, we literally had to ask them to take it out in the parking lot.
It was great audience drama. The audience loved it, so
Yes.
hopefully we'll have some good infighting here.
Right. So I'm sure Suzanne, who is the head of global research at State Street, prior to that, at the head of research for the financial services industry at IBM, and most prominently on her resume, although she tends to put it at the end, she's a member of the board of advisors of something called the Center for Finance, Law, and Policy at Boston University. So with that, it's all yours, Suzanne.
Thank you, Con. So we have a rich topic to explore this afternoon, and our discussion really centers around one question: what is the outlook for regulation, hence the crystal ball reference. So I'm honored to be here today to moderate our highly esteemed panel that really needs no introduction. So we have with us today John Dugan, who is the former comptroller of the currency and is currently a partner at Covington & Burling. We also have Aaron Klein, who is the director of Financial Regulatory Reform Initiative at the Bipartisan Policy Center. And last but certainly not least, we have Karen Shaw-Petrou, who is the co-founder and managing partner of Federal Financial Analytics. And Karen also serves along with me on the board of advisors for BU's Center for Finance, Law, and Policy. So I will hopefully be making your day today by saying we've got the Renegade panel. We are not going to have any prepared remarks. This is actually, we're going to jump straight into the conversation, which I think will work really well given that we're the last panel of the day. So the first question to the panel, any of you can just jump in on this. Throughout the day today, our discussions have really centered on the current state of affairs with respect to systemic risk and regulation. Of course, all related to the world of investment management. So let's spend some time now discussing the future of regulation. So what is your vision for financial stability regulation over the next 5 years, and if you would be so bold, over the next 10 years?
Just point of clarification, we're talking about asset management, right?
Yes, we are talking about asset management. To the extent that you want to bring in the other sectors in terms of banking or insurance, if it lends itself well to the discussion, then you, of course, can bring those in.
Okay, well, I'm happy to start. So we heard a lot today, partly about SIFI designation. We heard about prudential supervision that comes from SIFI designation, and then a looser discussion of prudential supervision. It wasn't clear to me whether that was in the context of SIFI designation or more generally. And my crystal ball, I still believe that the tide has really turned, notwithstanding what the Financial Stability Board did last week, which sort of ran against the tide. I think that all of the action now really, and particularly in the near term and particularly in the United States, will focus on regulation of the activities of in the fund space. And I say that not with respect to those that are deemed systemically significant. I'm talking more generally, and I think it's more likely to come from the SEC than from FSOC or the Fed or anyone else, although I do think the fact that the FSOC has had this role where they've come out and made recommendations with the support of the then chair of the SEC with respect to money market funds, that specter will continue to put pressure on the SEC to act in this space in a way they might not have otherwise acted. And I think that's where all of the focus will be. And I think one point of clarification I would say is I don't think it's really prudential supervision so much. As a former prudential supervisor, I think more prudential supervision as the type of regulation supervision you do to stop an institution from failing, to prevent it from failing and causing problems. I don't think that's really the same thing with respect to the mutual fund industry or the fund industry more generally. That's not to say that it's only about disclosure, though. There are substantive rules that apply about restrictions on liquidity, leverage, types of activities that certain kinds of funds can engage in that are still designed to protect investors, but they are substantive in nature. And so I think what the SEC will look at is strengthening those rules, but in some cases beginning to cross the line into what I do think of as prudential supervision. So very quickly, I mean, if you look at what Mary Jo White talked about in her speech, which was potentially beefing up reporting, systemic stress testing, risk management, and I forget what the fourth one was, resolution. Reporting, that sounds very much like a traditional type of regulation that you would do of investment companies. Resolution's a little bit far afield. It's a lot to do with living wills now, but planning for the orderly resolution of a company is arguably consistent not just with prudential resolution, but how you would do market-based resolution to keep orderly markets. I think where it gets a little different and starts to shade into the type of regulations very popular today among prudential supervisors is when you start talking about stress testing, when you talk about liquidity regulation that goes well beyond what the kinds of things they're talking about in current law with respect to investment companies. So it's a bit of a gray line, but I think that's where all of the attention will be. I think the FSB's efforts will go on. I think they'll cause a lot of controversy, but I think there's such a political backlash now to the farthest reaches of SIFI designation that I actually don't think it's going to happen with respect to asset managers.
On the SEC front, just a more pointed question on there. To what extent, from your purview, do you believe that they're prepared to take on this additional responsibility as you've outlined?
I think they're definitely prepared. I think they want to do it somewhat as a preemptive strike to stop the others from playing in their sandbox. And so I think they've already signaled they're going to move down that path. The question is how far they go and what kinds of things they do, and is it more within the traditional ambit of investor protection fund style regulation, or does this go somewhere beyond that and shade into something that looks like prudential supervision? And we'll have to see.
So I'll take a crack at the question, which is kind of, where I hope the future of regulation goes.
Distinguish between hope and will.
Well,
There's a difference there, so
so
you can answer both.
I'm going to start with hope, because
place to
I
start.
hope they will follow my hope. I think a couple things. One is I think that you want to see a return to balancing financial stability with economic growth, right? The most stable system is the one with no activity. And clearly that's what nobody wants. So you need to have a balance between stability and growth, and achieving that balance through wise regulation needs to focus on not just the financial system and financial stability as a means, but the purpose of the financial stability system. The financial system is a means, not an ends, right? The end are consumers, the real economy, and end users. And so how do you create a balance between the stability in the system and providing products for the real economy without having the system go haywire, which, depending on the, not to relitigate the prior panel where it went off course, but these things mirror instability in the broader real economy as well. I hope that the data point that was made on the first panel will be that financial stability will not just be a mandate of parts of the government, but a mandate of the public and the markets. That enough data and information will be out there and the public will be engaged enough that the public will serve as a check in addition to the government in promoting financial stability. I agree with John that I think we're headed in a path, or hope we're headed in a path of activities and practices regulation and not kind of a focus on designating institutions. The flip side of that is I actually think that in 5 to 10 years we'll be thinking a little bit about the other side, which is de-designation. Dodd-Frank, in my opinion, envisioned a two-way street and not a Hotel California for designation of entities. And we may be talking about entities that are no longer SIFIs and can be de-designated. I'm going to close with one final point on this, which is the conversation at lunch that Dan and Paul Tucker discussed about the distinction between providing liquidity and being the lender of last resort and being a bailout. I hope in 5 to 10 years that conversation has been decided decisively on the side that the provision of lender of last resort is not a bailout. People reference the Hal Scott and Glenn Hubbard op-ed. They courageously followed in the footsteps of my fellow panelist, John Dugan, who along with Peter Fisher and Chuck Muckenfoos put out a paper from BPC last September making that exact same point on the Fed. And I think we're beginning to see the building of consensus following John and Peter and Chuck's brave staking out of this position, that debate needs to get behind us. And we need to understand the distinction between liquidity and lender of last resort and bailout.
I certainly agree with, agree with that. So I think I'll start with what I think will be happening, and certainly in the next few years. It's because what we see happening, one of the things we do in our practice is we analyze what we call policy drivers, the regulatory, legislative, and broader public policy demands made on specific activities, products, lines of business, and then on the parent institutions. And what we try to do in these analytics is that we hold the broader drivers of competitiveness equal, whether it's interest rates, macroeconomic growth, one company's ability to sell better than the others, and we look down at the bottom line of holding all these things equal. Are you able, based on your current and prospective regulatory framework, either to compete against institutions in a different regulatory framework, or, since we're very ecumenical, we look at it both ways, or do you, because you're not as regulated as another institution, gained comparative advantage? And having done this work with policy driver analytics in the asset management arena, I think to us it is very clear, and it's been to several of our clients who are redesigning their business strategy, that it is extremely difficult, not throughout the asset management sector, but on particular business lines for a large bank, especially a GSIB, to be competitive vis-a-vis a major non-bank provider. The reasons for that, we've spent a lot of time talking about whether the activities warrant systemic or prudential regulation, who should do it. I'll just tell you the facts of the matter on the ground is whether the rules are right, wrong, or sideways, they all have a lot of cost. And the costs drive business, and the business is changing. I think we will see a significant shift of a number of activities, some of which must move out of banks by virtue of Volcker, other of which will move out of banks by virtue of, say, the leverage capital requirements at the GSIBs, some of which are under considerable strategic threat, particularly the ability of bank-affiliated asset managers to engage in activities, very low-margin activities like custody, for example, or transfer agent activities. If those major, and one might argue utility functions for the asset management industry, custody, for example, are forcibly separated by the inter-affiliate restrictions we talked a little bit about in the last panel from the earning part of the asset management equation in a large bank, especially a GSIB, particularly offering funds, a variety of wealth management, other types of asset management services. One of the little noticed aspects of the FSOC inquiry is a look at exactly that intra-group risk, and it poses a significant strategic challenge in the bank field. So we're going to see the business redefine. What I hope comes out of that is a new focus. I hope we don't wait till the business has redefined. It's all moved into institutions in an advantaged non-prudential regulatory framework. But most importantly, I think we need to think very hard about resolution. That was the key, I think, point to the lunch panel, how critically important that is. And especially when folks at the Federal Reserve Bank of New York are now talking about not only being the lender of last resort, but also the market maker of last resort. The backstops that may be behind the asset management industry are not the traditional ones we're used to thinking about. The need for that kind of support remains to be seen. The ability of asset managers to resolve themselves operationally under stress in the absence of recovery and resolution plans is uncertain. And I think one key piece the FSB has undertaken, which hasn't been talked about, we talked about their systemic designation standards, the new ones. Last year, they put out a very important paper that I think we're not paying enough attention to, which is systemic resolution for people who hold other people's money. That's the real key function of asset management, to hold other people's money. And it's vital, therefore, that under stress, an asset manager has the operational capability to find it in the dark. That, to me, is the policy priority, not so much the designation and even activity or practice discussion we've been having.
I can relate to a lot of your comments, specifically as it relates to me working for State Street. We're one of the largest custodians in the world, one of the largest asset managers in the world. So that problem that you're describing is actually very real to each of us within the organization. So it'll be very interesting to see how all that shakes out. I know that my role here is a moderator, but I can't resist. I'm also the head of research, so I can't resist sharing just at least one statistic, maybe more as we go through this conversation, but related to your point, Karen, somewhat related to your point as well, John. But when we asked hundreds, we conducted about 200 face-to-face interviews with government officials, policymakers, and regulators all over the world across 16 countries and asked some pretty compelling questions, one of which was about essentially the amount of time and money that is being spent on financial reform measures. So throughout the day, we've had a lot of talk about the ROI and the cost, right? So just to put some numbers on this is just opinion-based, right? Meeting with these government officials, regulators, politicians, only 16% of them believe that the majority of time, money, and energy is spent on the most relevant activities. So just to punctuate the point that you made, Karen. So based on this 5 to 10 year outlook, each of you had slightly different points of view on that. What are the implications? Specifically for 3 different participants, investment management providers, of course we have a healthy constituency in the room of them, government officials and regulators, and then finally, maybe the most difficult to answer is consumers.
Well, yeah, I'm happy to jump into that. The first is watch the activities and practices about your own conduct and from the investment manager's standpoint, that in which you're investing. I mean, a lot of the problem in the last crisis, I guess a couple broad brush points, right? The history of financial crises it's a mixture of a mispricing of assets. So kind of the answer to the question of your research is almost always going to be people don't think the asset's problematic. That's why everybody's invested in it. And so, you never look for the thing that the consensus is suspect on, because then you won't have a crisis in that space. But watch for the activities and practices of other investments activities. 2 is these are global. The last one happened to be as a result of a U.S. asset class. The next one probably won't. And so just simply staying within our shores in the seek for activities and practices can lead to the same false sense that I'm sure our colleagues globally thought that, how could U.S. subprime mortgages possibly infect the financial system of the world? We may be thinking the same thing in China. So policymakers have to think in that space globally as well, and not just patrol our borders, but also think globally. I think the third point I'd make in terms of consumers has to do with making sure that consumers themselves have access to products and practices, but don't ending up kind of over-leveraged. I'm very concerned about student debt. If you think about some of the hallmarks of what we're told to consumers, houses always appreciate in value, the value of ROI of college is always positive and growing. Don't worry about the price or the terms. There's not competition in the space, and there's kind of underwriting is done based on weak criteria. I'm very concerned about student debt saddling the next generation and what that means going forward. And so I guess I'll stop there.
I think the 3 areas joined together, and what is the future from a industry, policy, and investor-consumer perspective really boils down to a fundamental question: is what is asset management? What are investment funds for? It sounds like a simple question, and I know everybody's website's full of, we are for you and all that sort of stuff. But in the wake of the financial crisis, I think it's the most profound question we, here in this room, and particularly starting with the industry, have to ask ourselves. This is one of the most compelling issues in the banking world, where one of the CEOs I know says, I just wish somebody would tell us what we're supposed to be. Are we a market utility? Are we supposed to be profitable? Are we supposed to be an arm of the Federal Reserve? What is it? Just tell me what it is, and I'll figure out if I can make a buck at it. It's a really profound question. But what is asset management for? And the industry has turned into a variety of very different business models. And I don't know that we've, since the crisis, stepped back and decided who is served by that, how, which risks are run where. Certainly many of them are run by investors, but I don't think all of them are. Not when increasingly asset managers are making direct loans with their own capital, not when they're becoming sources of maturity transformation. I think Marcus's point about the liquidity illusion is an important one, but I also think if you look at the change in one sector, corporate finance, and look at how essentially in the last just 2-3 years, corporate debt, corporate loans, particularly leveraged ones, are not loans anymore. They're an asset class. And the asset management industry, both for funds and managers themselves, including originating loans, has changed the nature of that business. So I'd like to step back and say, what is the business? What's it for? And then who's at risk how? And I don't know that we really have a good coherent answer to that entire question.
It's very interesting, Karen, that you say that. We, in addition to the reaching out to, these hundreds of government types, we also reached out to thousands of investment managers and asked them that very question, all fully anonymous, face-to-face. How do you define success? And I will tell you that 90% of the time, they were unable to do so. But there's a very healthy, silver lining out of this, in that the industry is going through a lot of self-reflection about its own business model. The definition of success used to be production of alpha. That's it. That singular. Now, alpha, for those of you that aren't well versed in this industry, not to use acronyms, that the term alpha means outsized returns above and beyond a benchmark. And now they're questioning that value proposition is no longer sustainable for many of them. So, point well taken, Karen. John, what are your thoughts?
So, consistent with what I said earlier, I don't think it's as likely that there will be a SIFI designation of asset managers, although the one caveat I want to say to that is that's barring some unusual event. If we have a significant event, if we have problems that generate any kind of runs in the system, or something that causes a big operational risk failure of a major asset manager, that could change the terms of that debate. So if that doesn't happen, I think, consistent with what I was talking about earlier, I think there's going to be more substantive regulation that applies across the board to activities. I think for providers, they'll spend a lot of time worrying about SIFI designation, but that's really where, as I said, the action will be, and it'll be a process of managing that regulatory process so it comes down with things that are reasonable. It will be a kind of a reset for the SEC to look at the types of activities that they haven't really looked at hard in a long time, particularly on liquidity and derivatives and leverage, those three things. And to the extent to which they're going to try to really make new hard substantive rules in that area. If there's designation, that's just a huge, huge problem. You don't want to be in that place.
No.
As someone who has regulated banking organizations and works with companies who have been designated, it is just a whole different world. And I think for the government, I think if they were to take on more designations, it creates, as it has with the Fed and insurance, the need to really create a whole new set of regulatory skills for industries they don't really understand. I'm one who believes that it was important to have SIFI designation authority added in Dodd-Frank. I know there's a lot of people who don't think that. I do think the government should have that power, having sat through a financial crisis where there was a lot of infrastructure built around regulating banking organizations and not others. But having said that, having the power and exercising it in a prudent way are really two very different things. I don't think the government needs to exercise it very often. It should be extremely judicious about it. And if they do that and they're judicious about it, then they won't have a lot of huge new responsibilities. If they start getting into things where they designate things, then it's going to really change the whole character of what they do and how they do it, and there'll be a lot more Fed influence on what happens.
Could I jump on what John's saying? Because I think that's very much been the case on the regulation of insurance. BPC launched a new task force looking at that. And as Hester's fantastic graphic in the last panel illustrated, the Fed today is the regulator of a third of the life insurance business and more than a quarter of the property and casualty business. This is by assets. through both SIFI designation and also thrift holding company regulation, which was provided to them. It's not at all clear to me who and how many people at the Fed know the business model of insurance, know what they're doing, and understand that. And there's a little bit of reason to worry. I agree with John that the financial crisis demonstrated that there needs to be a mechanism within the government to, at the time of crisis, and hopefully well before, properly identify and pull into the regulatory net actors whose action could threaten the stability of the financial system. I think that is very different than an unforeseen result of the financial crisis being regulatory responsibility to 12 Federal Reserve regional banks for the capital regulation of Mutual of Omaha, which is currently one of the companies out there, or TIAA-CREF, which may be a little more relevant to some of the academics in the audience.
Could I just add, I was going to say boots on the ground, but maybe a heels on the ground perspective. Because we advise a large insurance company that has had the distinct displeasure of having been SIFI designated. And Aaron's point is a really important one. Nobody knows what to do. The Fed has no clue how to regulate this behemoth. And that's not to say that it isn't, we can spend a lot of time, is it or isn't it systemic? There are aspects of it that my own view are and parts of it that aren't. But the real business reality is that they are waiting for the Fed to come up with the insurance regulatory standards. It's like my bank CEO example. In a sense, you just, I don't care what they are, just tell me. I don't care how stupid they are, at least tell me so I can manage this thing. Tell me how I do a living will for this company when all of the criteria the Fed is putting into the plan are bank-centric, and we're not a bank. So it's the worst of all possible worlds, being SIFI designated in a framework which has yet to determine how to regulate. When the Fed for GE Capital has had GE Capital as a systemic finance company for a year or so, just put out a proposal which says essentially, gee, now what do we do? And ask for public comment on that, which is sweet, but if you're GE Capital and you've got quarter over quarter, it's a very dangerous situation in which we have regulated entities without rules. I think one of the top priorities needs to be to come up with a little bit more certainty, not only in terms of the designation process, but for the entities that are in fact now designated.
So shifting gears and talking about a fun topic, politics. So it's already election season for 2016. How could that be? How does the 2016 election influence the fate of financial stability regulation, if at all?
So I'm happy to start and say, contrary to Con, I think I'd be, earlier, Mark, excited for Chairman Gallagher and excited for Chairwoman Stein. I think that you're going to see the framework of Dodd-Frank have a next generation. And I think that's going to be a telltale sign where the founders kind of give way and the people that were there in the beginning give way to the folks. And it's that very first transition, right? A lot of people actually argue that the Jefferson-Adams election was the most important in American history because it established the precedent of the peaceful transition of government and the agreement by Jefferson, the losing party, to go along, and he successfully relitigated the issue 4 years later. But I think in some ways a testament of the Dodd-Frank system working is going to be how this next generation in charge handles it. And I think that's going to be a huge area. For my own end, I'm not sure it's going to be necessarily terribly different. I think a lot of the results kind of to some degree showed, and on the process have showed varying degrees of middle ground. But ultimately it's very unclear. And as Con points out, could swing in multiple directions, but a fresh set of eyes and fresh perspectives may be very valuable to establishing the right set of precedents going forward.
So my take on this is, I think for the big banks, it's not going to make much difference. That they're already so politically put in a place where they're going to be subject to a lot of regulation, and it's a very difficult space to get out of, and the politics work that way no matter who gets elected. I think it's different for the non-banks. And I think it will make a difference if the Democrats run the table or if the Republicans run the table. And I think if the Democrats run the table, there'll be more regulation than there will be if the Republicans do, particularly in the area of designation. I think there's tremendous backlash among the Republicans to expanding SIFI designation. And, and you heard a little bit of it today, the notion that the FSB is going to predetermine what the United States does with designating individual firms, raises sort of the specter of blue helmets in the United Nations and all that stuff. So, and that whole thing, and I think there's just more of a, in the wake of the crisis, more of a willingness among the Democratic leadership and the populist wing of that to engage harder on that. And so I do think it will make a difference in that space.
I think that both what Aaron and John said is right, but I want to go back to a point, John, you made, which is that I think you're right if nothing bad happens between now and then. Because
That's a good
this
point.
is what scares me a lot. I think Commissioner Gallagher is absolutely right looking at illiquidity in the market. There are major geopolitical stresses with significant operational risk, especially in areas outside the banking system where there are not the contingency planning. Whether that works or not, we'll have to see. That at least it's been done is a bit of a comfort. There are a lot of scary things out there in financial markets and then in the framework in which financial markets operate right now. And we've had several near misses. The October Treasury, quote unquote, flash crash last year has gotten, the FSOC right now is talking about that today there are some really big issues out there. Some of them, in my own view, the result of some of the new rules. When I think it's been said that we look at each of these rules on its own, but some of the combinations of them, particularly the capital liquidity and the Volcker requirements together, have put tremendous strains in financial market liquidity in the fixed income arena. And if we have another close brush, if the Fed doesn't get absolutely every little signal it sends on tapering totally right, and the sun is out on the day it says whatever it is it's going to say, maybe we'll make it through, but it does scare me a bit.
Let me also pick up on a point John made. The populism exists very much on both sides. In 2008, the single biggest fundraising day of any candidate was not Barack Obama, was not Hillary Clinton, was not John McCain. It was Ron Paul on Guy Fawkes Day, who, on a process for audit the Fed, which I think kind of morphed to end the Fed, raised more money, mostly from small dollars. I don't think there were, large mega
Wasn't a
bundlers
lot of
going
Wall
around.
Street money in that, no.
Wall Street, right? That day raised more money for him than for any other candidate in 2008. It's very plausible that there'll be another Paul running for president. And so the financial crisis has had a more profound impact on the electorate in both sides than I think Washington and many people in the industry truly appreciate when you talk to the voting public writ large.
Well, that's the kind of bipartisanship that I don't think you were thinking about when you took your job. I still think that tends to meet more in anger at the banks than it does with respect to the non-banks, which are a little bit more apart from it. And that populist kind of fervor is not so bipartisan when it comes to this. Just my take on it. The other thing I wanted to make a point is I do think, and I think this industry feels it a lot, there's this notion that, gee, the Fed, is looking to regulate the world, and they've got their fingers into everything, and they're empowered by Dodd-Frank, and they're really looking to expand their authority. They've got a lot, since we're on a political question, they are under a political microscope right now on the things that Aaron just brought up on audit the Fed and reorganizing the Fed. And history has shown time and again when they get pressure on things that relate to their independence and monetary policy, it will cause them to be less assiduous about how they pursue other kinds of policy initiatives. And I think that will be a dynamic that will definitely be in play as we go forward.
That's a great point. So now for the elephant in the room, how should we think about defining and measuring success when it comes to regulation? This is probably the toughest question to answer of all these.
So, well, I'll start. I mean, Aaron talked about this trade-off, and I sometimes talk about it between growth, and I think Doug talked about it on the previous panel, between safety and soundness on one hand, growth on the other. I mean, you can have speed limits that stop people from having casualties at 60 miles an hour, and you'll save even more lives if you take those speed limits down to 5 miles an hour, but then goods and services don't get to where they're supposed to go in the economy. It's hard to measure when that trade-off actually occurs, because apropos of something that was said earlier today, there's a huge benefit from avoiding a financial crisis, and people are willing to pay a certain amount of excess costs to do that. And it's also, by the same token, very difficult to measure when an individual regulation or a set of regulations is actually the thing that's causing growth not to happen. So because of that, it's very difficult to measure the success. Having said that, there are times when it does emerge. I mean, I think even in the pro-safety, less concerned about growth era that we've had post-Dodd-Frank, I think there was a real realization in the government across the board that they overdid it on mortgages, and that mortgage credit wasn't getting out to people, and people were being way too conservative about it, and it caused some adjustments to the QRM rule. It caused some adjustments to the way the CFPB looks at things. So I think a measure of success, we don't have systemic crisis. That's number one. But B, the other flip side of it, we don't have obvious circumstances where the regulation has clearly impeded the economy or impeded financial services being delivered to people.
So I'll pick up on John and point out, I think that's right. One of the problems with cost-benefit analysis, which sounds great in theory and is incredibly difficult in practice, is when the benefit, what are the benefits of avoiding a multi-trillion-dollar crisis? Well, if you say, well, this rule has a 0.1% chance of avoiding a multi-trillion-dollar crisis, then on a cost-benefit basis, it could be worth hundreds of millions, billions of dollars. Nobody in this room can say that any one rule has a 0.1% chance of anything. We have way too much hubris in throwing numbers and estimates out there without understanding basic confidence intervals, standard of error, et cetera. And as a result, it's a framework that I think you're better off thinking not in terms of trying to quantify everything. Numbers in equal numbers out. Doesn't mean the numbers mean anything. But instead thinking about these trade-offs and where are you kind of on the curve. I'm going to give a definition of success in which you have an efficient flow of capital, you have early warning signs to bubbles, and you have problems that end up without creating crises. I think that the dot-com bubble is not a failure. Yeah. It's not a failure that Pets.com doesn't work and Amazon does. I don't know if you guys saw the NASDAQ hit 5,000 again. The last time it did was 2000, and they showed the relative market values of companies. You still have Microsoft and Intel. But I mean, you have Apple and Google, which didn't exist. You have Netscape there. Tremendous amount of capital was misplaced. That's fine. That's capitalism. That's a good thing. You didn't have leverage. In part, I think Marcus kind of pointed out some of these New Deal concepts got rid of. If this had been if we didn't have the New Deal era, .com would have been the financial crisis that mortgage was, because we would have had the type of speculative leverage that didn't exist in that. And I think success will be measured the next time we have a collapse without a crisis.
It's a great question, Suzanne, and I had to think. I thank you for warning us that we were going to ask it, and I thought about it, and
now I look so spontaneous as God.
Well, the answer I thought about ahead of time, so no misrepresentation, is no unintended consequences. I think we may well have another systemic crisis, particularly if, for example, don't worry. I scared my dog. We might. And I know this is going to be a real shock to a couple of our populist friends. That might not even be the big bank's fault this time. Sometimes really bad things happen in financial markets that are nothing to do with what I've called the evil banker theorem. 9/11 is a very sad but important case in point, because That created enormous operational risk when the towers went down and blew the payment system out. Stuff like that sometimes happens. So what we need to ensure is that if it does, that the regulations mitigate the damage. We also need to ensure successful rules, as I said before, don't have unintended effects. And the one I mentioned a minute ago, for example, the significant shortages in fixed income market liquidity that could well be systemic. If that is an artifact of regulatory policy, and I think it may well be, that's a very bad thing we should be thinking about. There are other areas where I think not so much each rule on its own, but all of them taken together may well have unintended effects, particularly as market shifts, the policy drivers I mentioned before, as policy drivers move the business around, things that neither regulators nor policymakers nor even consumers really want to see could well happen. And that, I think, would be regulatory failure. And we're already seeing warning signs of that right now in the financial markets and who is doing what how.
So in the interest of time, just going ahead to the final closing question in real, short, snappy response, if you can, to allow for time for questions. What is the one recommendation you would make to each of the following industry participants? Investment managers, policymakers, and finally, consumers.
So I'll start. For policymakers, it would be very, very judicious in how you use your SIFI designation authority. It causes so many problems. It sure better be worth the cost of doing it, even though it's an important power for the government to have. For asset managers, I think they have to be very mindful of working constructively with the SEC and whatever process they're going to go through to come out with a reasonable reset of some of the rules that are involved, particularly in the area of derivatives and leverage. And I don't know what I would tell consumers. Hope for the best.
That's a hard one.
Parent told me, I think, again, from the answer to, in my mind, for policymakers and the asset management industry is the same. Resolution. Because so many other regulatory questions really follow from that. If different types of asset managers can indeed experience severe stress or fail without there being significant risk to investors or worse, systemic consequences through contagion, fire sale, resulting operational risk, then much of the regulatory discussion we've had today over designation, many even of the capital, leverage, and liquidity rules becomes a great deal easier because you go back to having asset management play with its own money. And that's really the most fundamental aspect of washing moral hazard out of the financial system, and from which an awful lot of regulatory decisions then should flow. So in my mind, the answer to your question for asset managers and policy is quick action on making sure that it is indeed possible for a very large U.S. financial services industry, especially when active in cross-border operations, to experience acute stress without resulting damage to all of the rest of us. And for consumers, I think they should hope so too. So I'll let that
Hope for the best.
So I'd say for investment managers, they should protect the healthy, well-regulated capital market system that we have that's a great advantage to America, as was stated earlier. I think for policymakers, it's to reach consensus, try to avoid scoring the easy political points that are now available now that financial regulation is actually a political topic. People forget that in 2006, my wife works in foreign policy, and I'd been spending years on the Senate Banking Committee talking about these subprime mortgages, and she kept telling me, nobody cares about that, Aaron. This is an election about Iraq and American foreign policy in the wake of 9/11. And in the first debate in 2006, she was right. In the last debate in 2007, the balance had shifted. Now, financial regulation has gone from being an afterthought to a central tenet. And so I think, it is tempting for policymakers to score political points as opposed to reaching consensus. And the third point for consumers, I would say, is take risk and take it wisely.
That's great. Questions from the audience?
My name is Perry, and I'm just a regular guy from Main Street.
Regular guy.
I've been listening to the panels all morning, and everybody seemed to want to cure risk, mitigate risk, stop risk, prevent risk, preempt risk, regulate risk. We live in a complex world, and the risk is here to stay. And as for wealth managers, whether to regulate or not to regulate is a big question. From what I read, the plain vanilla thing, wealth manager is the helper. Take your money, I can give you a higher return, take it from the saver, give it to a corporation. It's as simple as that. If the market or crisis happens somewhere, okay, you don't want your money, we give it back to you at a loss. But if a wealth manager or asset manager starts doing something outside that plain vanilla helping, then it opens the door for regulation for you. And it is very tough because the SEC and the central bank, the Fed, they're different fiefdom. This one is fighting for control. I have more power, and it's like that. But if you now put MetLife, big insurance companies, you make them significantly financial institution, then if a big catastrophic event does happen, we don't know why it will happen, if it will happen, how it will happen, what will cause it, but we do know that in 100 years, 50 years, one major cat event will happen. To the banking system, to an insurance company, something will happen. Now, if you label MetLife and the likes significantly financial institution, then when they do have a catastrophe, when alongside with the banks, they have to now go to the Fed and beg for money. And that now overstretches the function of the Fed, gives the Fed more load. So that is what I've taken since morning. I said, let me share this comment with the panel and see what the reaction will be. Thank you.
If every regular person was as well informed, I suspect we could have a very different system. I'd probably be a lot more comfortable with a lot of disclosures. I think the point you make is true with respect to risk. I often posit this in the bank context, but I forget if it was Peter or Brian said somebody earlier, thousands of funds fail a year. I think that's great. There's 6,000 banks in America, in a healthy regular year, not in a crisis. There should be some failures. In fact, the longest period in American history where there have been no bank failures was the run up to the crisis. And that, to me, was indicative of a problem. And so the question becomes, how do you create a culture, both in the marketplace and among regulators, that promotes a healthy degree of failure?
I absolutely agree with that, because it again reinforces the importance of resolution, so that failure is rewarded by failure, not by rescue or at the expense of all of the rest of us. That's really the experience we went through in 2008, was a combination of taxpayer rescues and tremendous amount of negative externalities, which cost the 17, 18, whatever trillion dollar number you like. There needs to be failure. Asset managers, as well as their funds, can and should fail. The same thing with banks, as Aaron just said. It's just the rest of us shouldn't be hurt when they do, and we're still not there yet, in my opinion.
There's been a little bit more discussion. I'm Ken Willman from Russell Investments. A little bit more discussion in this panel about the ultimate consumer, the ultimate investor. But when you look at, Aaron, your point about, take risk, but take wise risk. And then you look at the statistics that millennials in particular, if anything, are overly risk adverse,
Yes.
et cetera. Be interested in thoughts regarding what we think both in the industry and, if anything, from the standpoint of a regulator, we ought to be doing vis-a-vis investor education as one tenet or one piece of financial stability.
I can't resist here, but so our data bears out what you're describing. You look at the millennial generation, but we look across all generations, Generation Y, X, baby boomers, and we found that the global average allocation to cash is 40%, 40% allocated to cash. That is a big number. And you look at that, and we look at the millennials, they have a nearly equal amount parked in cash as the older population does. You can argue there's a great, case for being conservative because of liquidity needs and things like that, if you're a baby boomer, less so for the millennials, right? And so the reason for that, if you peel back the layers in all of our focus groups, it's that they do not trust the markets with their money, period. And why should they, right? They've seen back-to-back crises, and they say, nope, I feel much more comfortable, just sitting in cash. And even though it's in my retirement fund, I still feel more comfortable it being parked in cash. You combine that with another statistic that we have when we constructed a full-blown financial literacy test, administered this test across 16 countries. In no way is this population anywhere near financially literate. They scored barely a D-. 61% represents the average financial literacy score. U.S. ranks 10th out of 16 countries. Singapore is number 1, Australia is number 2. Can't we do better than that? You put those two together, and you've got a really compelling case for doing something different. I don't know if anyone can comment on this.
So I'll jump in with a few points. One is that financial literacy is important, but it's not clear that we have an answer to that. Your test result is after years and years of more and more resources going into financial education, and nobody seems to be coming out any better. It is not at all. There was a large bank that once sent all their bankers into schools for a day to promote financial education, which I thought was wonderful, until I talked to a teacher who said everybody thinks they can be a teacher because everybody was a student. So I've gone to a bank, let me be a teller for a day. Mm-hmm. It's not at all clear that some of these investor education or financial education, while mean well, actually perform. I think that, providing the consumer or the individual the right level of financial knowledge to be grade appropriate, I think is a challenge that we're not there and have a long way to go. I think there have been profound changes to the millennial generation as a result of the crisis. One of the most fortunate things that happened to me, I've had a lot of good breaks in life. One could argue the biggest was my birth year. It was one of the lowest birth years on record. Everything from getting into college was easier to finding a job. My nephew's applying for college. There are 25% more students his year than kids his year than mine. I don't know if BU's taking 25% of the 25% more students. But watching what happened to their family, watching this has had a profound effect. At the same time, they're being saddled with more debt than prior generations. And so I do think that there's a real risk that the efficient flow of capital will be retarded in a different way. What do you do about it? I'm not entirely sure. I do think that one of the more interesting facts, I'll close with this, is that it's not clear to me that as we move more to an investment, a knowledge-based economy, that you don't have greater ability to create value without taking on debt.
I think there's also an industry aspect to it, and one of the reasons, it's not only the crises, but I think on the margin, the more, we're going through a lot of cleanup, whether it's all the subprime mortgage, fraud-related issues, now the benchmark manipulation cases, some of the issues in the market in terms of pricing. I think there's a real trust issue here, and to I don't think it's more signs in the Washington Metro. Please don't. They're doing this thing, we're a bank, you can trust us. Well, it's not that simple, but there is really a significant residue, I think, in the public mind. One of the reasons the populist ire that John mentioned is as fired up as it is because people think we've done them wrong, and sometimes they're really right.
Yeah, to give you a statistic behind that, so only half of the investors believe that their provider is acting in the investor's best interest. Only half, that's a pretty low number. Yes? Oh.
One consequence of ever-increasing regulation in the commercial banking industry has been a dramatic decline in the number of commercial banks that there are. If you look at, you mentioned, Aaron, that there are 6,000 banks today. 10 years ago, there were 16,000 banks. I'm wondering if you see a similar consolidation in the asset management industry as a reaction to this fear of risk on the part of the regulators.
Kind of depends on how, if you're tracing it to regulation, and there undoubtedly has been a huge wave that's been very difficult and affected the way bankers do their business and their enthusiasm for doing their business and their willingness to stay in the business. I think the answer to that will depend on how significant the new regulation is that comes along as a result of all the things we've been talking about. I don't think it's clear to me it's going to be like what we have now in the banking industry is just wave after wave of not just intense regulation, but supervisors bearing down at the same time. And it's a really huge struggle, not just to keep up, but to keep up and also figure out how you do your day job and how you sort that out so you do the things you're supposed to be doing in terms of taking risk and making money and the like. We're a long way from that, and God help us if we ever get to that place. But I think that is the potential downside, worst case scenario.
So let me just make 2 points on that. One is, I think the fact that we have a diversified banking system is a great value to the American economy and provides us ways to bring capital more efficiently to particularly small businesses and consumers that other countries like France and Canada without a diversified banking system by size lack. On the other hand, we had 16,000 banks because we had a really inefficient policy that didn't allow for intrastate branching and operation. And so the idea that 16,000 was somehow the natural free market solution and now regulation is changing that, I think there was a bad policy or an outdated policy. I'll say it may well have made sense in the 19th century, but it was an outdated policy that was wisely changed, and that led to one wave of consolidation that may actually continue to be playing on.
I just give another heels on the ground response, which is that we've been working hard on thinking through a mid-sized de novo bank charter, and we'll be damned if we can figure out how to get the ROI over 17. And if we can't get it over 17, we can't get the money. It's just not a profitable business model. Some of that's interest rate driven, but a lot of it is structural. And I don't see that challenge facing the asset management industry. And indeed, I think there are a lot of reasons why it could well expand with new opportunities, in part, again, because of the policy drivers I mentioned.
I agree with that. All right, one more question, then we got to wrap. Lots of hands in the room, time for one more.
I didn't hear any of you mention in your predictions about what would happen over the next 5 to 10 years, and I apologize if I missed it, but an attempt as part of macro-prudential regulation to control asset prices. And this is something that the Fed has long resisted. You know, there were calls after the dot-com bust for the Fed to lean against credit bubbles. And Ben Bernanke gave what I thought was a great speech in 2002 explaining why he didn't think that was advisable for regulators to interfere in the allocation of capital to issuers and risk to investors. Do you see a change in position now? There have certainly been suggestions among some policymakers that there could be macro-prudential tools or policy measures developed to try to control risk premia, which, to translate for everybody who hasn't been following the debate, really means to exert some control over asset prices. Do you think that's an idea that's just being discussed, or one that somebody will try to act on?
So let me give you a couple of examples where I think this could come up, and one current debate that I think is quite relevant to what you're talking about. So our financial crisis, of course, as people talked about earlier, had a big, whether you think it was Fannie or Freddie, a huge component that was all about housing prices and poor underwriting standards and the like, and a housing bubble. Some countries in the world have much more express power to control loan-to-value ratios on a one-off basis as a way to regulate and to put dampen prices in particular markets. And I have heard financial policymakers say that that's a far better way to kind of come at the problem than raising interest rates generally across an economy. So it's kind of using a macroprudential tool in a more targeted way. But it does raise the specter of the government getting into the picking and choosing business and trying to make decisions about what's an overheated market and what isn't. I don't think they're there yet, but you do hear people talk about it and seriously talk about it in the wake of what happened in the financial crisis. The place where that debate's going on right now is in leveraged lending. It's a very interesting debate because Traditionally, bank regulators have focused on the assets that are on banks' balance sheets. Leveraged loans have at times, the underwriting's gotten much worse and more risky. And during the financial crisis, one of the lessons that came out on the mortgage-backed security side was people were saying, gee, these mortgages are really terrible. I was there when this happened. And shouldn't we do something about the underwriting? And bankers would come in and say, we're selling all the mortgages. It's going to a second place. Somebody else is willing to take the risk. Why should you tell us how to change underwriting standards if we have a willing seller, willing buyer? And of course, that didn't work out so well. I mean, the mortgages got so poor, and we had a very poor understanding of how the things actually didn't leave the bank and could come back on the system. And in the leveraged lending space, there was a similar kind of lesson that started to get learned, because while a lot of those loans get sold and syndicated to investors, during the financial crisis, some got stuck in the pipeline, and banks ended up taking some risk for it. Now, in the current debate, there's a lot of concern because leveraged loans, the underwriting's gotten much weaker again. However, banks are not holding much of this on their balance sheet, and the pipeline has gotten much shorter. So the actual safety and soundness prudential argument for a bank to do and the bank regulators doing is not as strong as it once was. And yet this hangover from what's been going on is informing the debate. And one of the arguments about it is it's a good thing that bank regulators are doing this, because otherwise we're going to create risk in the financial system by heavily leveraged companies that will be extremely vulnerable to a downturn, and it's a good macroprudential thing not to do that. And there's a very good speech about this that didn't get much attention by Governor Powell of the Federal Reserve, leaning in the other direction, saying, you know what, if we're doing credit and credit underwriting, picking places, we shouldn't do it for those sorts of reasons. We should only do it for the safety and soundness risks and the like. And so it's an interesting debate.
Yeah.
Homework for everyone. That's the homework assignment. We'll end on that note. Thank you all very much for the time. Thanks to our panel.
Not you. No, shush. Not you.
That was an excellent panel to close the day on, and Con's given me the opportunity to just say a few words before we adjourn, and I think there's a reception following this. The first word is one of thanks to Boston University and the Center for being such terrific hosts for this event. Con, you and your team have done a terrific job. The facility has been really quite wonderful. It'll be a memorable day for all of us. And so if you join me in a round of applause for Con and all the folks at the center. I am not going to attempt any kind of summing up, but I did want to leave you with a couple of thoughts, at least, in response to some of the things that have been said during the course of the day. One is the Institute's position on behalf of the regulated fund industry in the United States is not, don't bother with us, we're not interested in your looking at risks that might exist in our space. In fact, quite the opposite. Our focus of late has been supporting Chair White and the initiatives that she has at the SEC. We will be engaging very vigorously on issues concerning new standards for liquidity risk management, stress testing, data reporting, and a whole variety of other things that she has underway at the SEC. I am not nearly as sanguine as some of those folks who we've heard from today about the course that the FSOC and the FSB might be taking. There's enough out there that's very unsettling, I think, for the Institute and for some of our members. And I just make 2 points in that regard. The last panel talked a little bit about the retirement system. Well, the FSB standards would capture our largest funds and our largest fund managers. And of course, if you're designated in the United States, it means under Dodd-Frank, prudential supervision at an enhanced level by the Federal Reserve. What that effectively does is it delivers to the Fed for that kind of supervision huge portions of the retirement assets that millions of Americans have put aside. I don't think they put them aside with that in mind. They certainly didn't put them aside as tools for macro-prudential regulation or control of asset prices. There's a lot involved in screwing up, if you will, to use a colloquial term, the efficiency and effectiveness of those funds for the missions that they've been serving so well at in our retirement world here in the United States, serving lots of investors. The last thing I would tell you is, having engaged in this debate from its very beginning, is that some of the most celebrated of those figures in the banking world have repeatedly told me, and I'll quote Paul Volcker, who one evening asked me out to dinner. And the first words out of his mouth were, "Paul, you need to understand, the banks are a relatively declining part of the financial world, and asset managers are, in relative terms, a growing and more important part. That's why we," and he's speaking for the Federal Reserve, "need to regulate you." This is a roving commission that Dodd-Frank has given. It doesn't expire. It's going to be there under the law for a very, very long time. And we've just joined in this debate at the very beginning of it. But I think as asset management succeeds more and more and more as a global phenomenon, and I'm very confident that it will, the desire of the central bank community to regulate it will not lessen. And therefore, this debate at this juncture, early on under the history of the Dodd-Frank law, is extraordinarily important. And I think there's issues of real consequence, not only for the largest of our members and funds, but for the 90+ million people who invest in America's regulated funds in their totality. So this event was a great dialogue. I'm pleased that we had lots of different points of view about this. I don't think this is the end of the debate. Perhaps we'll have a reprise of this at some point in future. I appreciate your interest in it, and I hope you will take what you've heard here today and speak to others about it, continue to think about it, because there are real issues of consequence for not only our financial system, but our nation at stake. So thank you all very much.
Just a last word before you help yourselves to our wine. It would be remiss if I didn't mention our student volunteers who were present throughout the day and actually present throughout the last few weeks. So if they would just stand up, those that are here, and there are some out in the hallway, and they can get a round of applause. I think, no? You're reluctant to stand up? Okay. In absentia, when Karen was on our program last year, and our student volunteers inspired her so much that she put together a course on shadow banking, which we're hoping to implement soon, really based upon the enthusiasm of our volunteers. Paul, thank you, back at you. It was a joy working with you and your staff and your membership, and we will do this again for sure. Thank you all very much for coming.